Now in the last lecture, we have discussed relating to the classification of the goods. Now in customs, say duty can be levied on ad valorem basis. Ad valorem is basically on the basis of value. Ad valorem is what? On the basis of value. Now the value can be either the transaction value of the goods, value can be either transaction value under section 14(1), or it can be the tariff value under section 14(2). So here section 14 is being there, it is dealing with the provisions relating to valuation of the goods, and this provisions of section 14 is applicable, same is applicable for both imported goods as well as export goods. It is applicable for both imported goods as well as the export goods. So what they say is, for the purpose of the Customs Tariff Act 1975 or any other law for the time being in force, the value of the imported goods and export goods shall be the transaction value. Value will be the transaction value of such goods. That is the price actually paid or payable for the goods when sold for export to India. What is transaction value? Transaction value basically it is the invoice price, the price actually paid or payable for the goods when sold for export to India for delivery at the time and place of importation, or for export from India for delivery at the time and place of exportation, where the buyer and seller of the goods are not related. Where the buyer and seller of the goods are not related, and the price is the sole consideration for sale. And the value is subject to such other conditions as may be specified in the rules made in this behalf. So we have to adjust the value as per the cost and costs and services that have been provided in the valuation rules. Now here we have to calculate the exchange rate for converting the foreign currency into Indian currency, or into Indian currency into foreign currency. So exchange rate prevalent on the date of presentation of bill of entry, or say shipping bill, or bill of export is to be taken, and the rate, as we already discussed, the rate pronounced by the CBIC. Is to be taken here. So this is important. Remember, exchange rate for converting foreign currency into Indian currency or vice versa, the same is to be calculated, same is to be taken on the date of presentation of bill of entry or shipping bill or bill of export. Now, for certain categories of goods such as say gold or silver, say some vegetable oils which are imported, brass, etc. Here CBIC has the power to fix tariff values of any articles which are specified in the first schedule and the second schedule. And in case if tariff value is fixed, then the duty will be charged on the basis of say tariff values. Here the duty will be charged on the basis of tariff value irrespective of their transaction value. Now as we have seen, for this purpose they have framed the valuation rules for import as well as export. Separate rules have been framed for, we have framed import valuation rules 2007 and export valuation rules 2007. Now that is custom determination, value of imported goods rules 2007. If you know the name, it's customs determination, value of imported goods rules 2007, and customs determination, value of export goods rules 2007. Now what is basically the place of importation? Definitions have been provided. That means the custom station where the goods are brought for being cleared for home consumption, or that may be, they say, Mumbai port, or it may be Visakhapatnam port. So the place where the goods are brought for being cleared for home consumption or for being removed for deposit in warehouse. Now here, now as we have seen, this valuation is a very, very important topic. Now here we have said that the value is the transaction value. Now what basically Rule 3 provides is, the Rule 3 also provides that, Rule 3 basically provides for determination of value. Rule 3 in valuation rules provide for what? Determination of value. And the value of the imported goods will be the transaction value. That is the price actually paid or payable for the goods when sold for export to India for delivery at a time and place of importation, where buyer and seller, say, importer and exporter, are not related, and the price is the sole consideration for such sale. Now here, this value, this transaction value, as determined in Rule 3, is subject to the adjustments of costs and services, of costs and services which are provided in Rule 10. You have to make the adjustments of the costs and services of Rule 10. So as per Rule 3.1, what is the value of the imported goods? The value of the imported goods shall be the transaction value adjusted in accordance with the provisions of Rule 10, that is costs and services as provided in Rule 10. Now, according to Rule 3.2, the transaction value is acceptable subject to the fulfillment of the following conditions. The transaction value is acceptable subject to the fulfillment of the following conditions. Number one is, there are no restrictions, there are, say, no restrictions as to the disposition or use of the goods by the buyer. But certain restrictions are valid, except which have been imposed by, except those imposed by law or, say, public authorities, geographical area in which the goods may be resold, or which do not affect what? Which do not affect the value of the goods. The value of the goods. So fundamentally, there must not be any restrictions as to the disposition or use of the goods by the buyer, except those which are imposed by law or public authorities in India, geographical area in which the goods may be resold. These will be regarded as valid restrictions which are imposed by law, public authorities, or geographical area in which the goods may be resold, or which do not affect the value of the goods. Then the sale or price. Second one is, the sale or price is not subject to some conditions or considerations, okay, for which the value cannot be determined in respect of the goods being valued. Sale or price is not subject to some condition or a consideration. There must not be any, say, tie-up sales, or, say, full line forcing. So the sale or price must not be subject to some condition or consideration for which the value cannot be determined in respect of the goods being valued. Then no part of the proceeds of subsequent resale, disposal or use of the goods by the buyer will accrue directly or indirectly to seller unless we can make the adjustment as per Rule 10. So if we are importing the goods for ₹100, and then out of the subsequent sale proceeds, 15 rupees is given to the exporter who is exporting the goods to India. Then here we are making the payment to the tune of 100 plus 15. So the value must be 115. So in case adjustment can be made as per Rule 10, then that will be accepted. Otherwise, then this rule won't be acceptable, and we have to shift to what? Rule 4. Then the buyer and seller, they must not be related, and in case they are related, then the examination of circumstances reflects that the relationship does not influence the price, or the importer demonstrates that the goods, whatever value is presenting in the bill of entry, it is, say, comparable with the value of the identical goods, value of the similar goods imported at or about the same time. So it is closely approximates what? The transaction value or the deductive value or the computed value of the identical goods or similar goods. So basically the valuation as per rule, value is determined as per rule 3. Read with what? Adjustments of costs and services of rule 10. Adjustments of costs and services of rule 10. Here rule 3, adjustments of costs and services of rule 10. Then we shift to what? If the value cannot be determined as per rule 3, then the value will be determined as per rule 4. Rule 4 is what? The transaction value of identical goods. Then if it cannot be determined as per rule 4, then we have to go to rule 5, that is transaction value of similar goods. Then as per rule 7, what rule 6 says? Rule 6 says the value will be determined as per rule 7, and if the value cannot be determined as per rule 7, then we have to go to rule 8. But at the request of the importer, the order of application can be reversed, that first rule 8 and then rule 7. Rule 7 is basically deductive value. Then rule 8 is computed value. And if the value cannot be determined as per rule 8, then we have to go to rule 9. Rule 9 is a residual method. It is a residual method. But here in rule 3, we have to make the adjustments of the costs and services of rule 10. This is very, very important. We have to make what? The adjustments of what? The costs and services of rule 10. And this is very, very important. So, as per rule 10.1, while determining the transaction value, we have to add the following in case the same has not been added already. That is commissions and brokerages except buying commission. If goods are imported along with the containers, then the cost of containers will be added, and cost of packing, whether for labor or materials. Then this is 10.1a. This is rule 10.1a. These are to be added, that is commissions and brokerages except buying commission. So buying commission, if it is given in question, same is not to be added. What is buying commission? Buying commission basically means fees paid by importer to his agent for services he is rendering for representing him abroad. So basically that is buying commission, fees which is paid by an importer to his agent for the services which he is rendering for importing, representing him abroad. Say I am the importer, I have appointed an agent in UK and he is rendering services to me. He may be searching various buyers and I am giving him the commission. Then in that case, you know where various sellers there, and I am giving him the commission. So whatever commission is given to him is a buying commission, that won't be added. Then cost of containers won't be added in case the goods are imported along with the containers, and that will be added basically. Cost of containers will be added, and cost of picking, whether for labor or materials. Besides this, 10.1b provides for what? What is to be added? The value apportioned as appropriate. The value, we have to apportion the value as appropriate of the following goods and services, which are supplied directly or indirectly by the buyer. The same are supplied directly or indirectly by the buyer, free of charge or at reduced cost. For use in connection with production and sale for export of the imported goods. We are the value apportioned as appropriate of the following goods and services. They are supplied directly or indirectly by the buyer, free of charge or reduced cost, for use in connection with production and sale for export of the imported goods, to the extent such value has not been included in the price actually paid or payable. What, say, Mr. X is the importer. He provides, say, component. This component is worth US dollar 5,000. Component of machine is provided to Mr. Y. He is the exporter. And this machine is given for US dollar 1,50,000. Now, since the exporter is not incurring the cost of component, this component worth US dollar 5,000 is provided free of cost by the importer. So this $5,000 will be added, and the value of the imported goods in that case will be what? 1,55,000 US dollars. So here the value apportioned as appropriate of the following goods and services which are supplied directly or indirectly by the buyer, free of charge or reduced cost for use in connection with production and sale for export of the imported goods, to the extent such value has not been included in the price actually paid or payable, namely. To the extent the value has not been included in the price actually paid or payable, namely, that is materials, components, parts and similar items incorporated in the imported goods, then tools, dies, molds and similar items used in production of the imported goods, materials consumed in the production of imported goods, then engineering, development, artwork, design work, plans and sketches undertaken elsewhere than in India and necessary for production of the imported goods. So this is added. Beside this, if any royalties and license fees is given, royalties and license fees, you have to add what? Royalties and license fees. They must be related to the imported goods. They must be related to imported goods, and they must be paid as condition of sale. So here the royalties and license fees related to the imported goods that a buyer is required to pay directly or indirectly. So fundamental thing is they must be related to imported goods as a condition of sale of the goods being valued, to the extent they have not been included in the price actually paid or payable. Now beside this, the value of any part of proceeds of any subsequent resale, disposal or use of the imported goods. The value of any part of proceeds of any subsequent resale, disposal or use of imported goods that accrues directly or indirectly to the seller. And all other payments which are made as a condition of the sale of the goods, of sale of the imported goods by the buyer to the seller or by a buyer to the third party to satisfy the obligation of the seller, to the extent such payments are not included in the price actually paid or payable. To the extent such payments are not included in the price, say, actually paid or payable. So these additions are to be made. These additions basically are to be made. Now here, this is 10(1)(a) adjustment. Now basically what we are doing is, say if it is FOB value of imported goods, this is the free on board value of the imported goods. Say it is US dollar 1 lakh. Say add adjustments under rule 10(1), which we have discussed, 10(1)(a), 10(1)(b), 10(1)(c), 10(1)(d) and 10(1)(e). So for example, if royalties and license fees is there, so it is US dollar 5,000 we have added. Say it is buying commission, we have to add buying commission? We are not required to add buying commission. Other commissions and brokerage it is, say $1,000 it is, that is to be added. Say if cost of containers, if the goods are imported along with the containers, 3,000 it is. And say if any component has been provided free of cost, say 2,000 is the cost of US dollars, the cost of component. Now this, after additions of adjustments, of 10(1), it gives customs FOB value. Now this is very, very important now, the adjustments which we will be discussing in 10(2). Rule 10 to adjustments are very, very important. Practical question can be asked from here. So it is say 1 lakh 5,000, 6,000, 9,000 and 1 lakh and 11,000. Now in this, what you add is add cost of transport, loading, unloading and handling charges. Loading, unloading and handling charges. To the place of importation. To the place of importation. From say US to India, what is the cost of transport, loading, unloading and handling? And add cost of insurance. Add cost of insurance. This is added. This gives you what? The CIF value. You have to convert the same into the exchange rate, into Indian currency exchange rate as notified by CBIC on date of presentation of bill of entry. On date of presentation of bill of entry. Convert it, you get what? This is CIF value being the accessible value. Convert it into what? Indian currency, you get the accessible value in INR. So basically what we have to add is, now say further you remember that if cost of transport is not ascertainable, if cost of transport is not ascertainable, it will be taken at 20% of customs FOB value. It will be 30% of customs FOB value. If goods are imported by air, then air freight, actual will be seen, or 20% of customs FOB value, 20% of customs FOB value, whichever is less. Air freight cannot exceed what? 20% of the customs FOB value. And if FOB value is not ascertainable, it will be what? 20% of customs FOB value plus cost of insurance if the same is ascertainable. Okay. And in case of insurance charges, if not ascertainable, it will be 1.125% of what? The customs FOB value. And if FOB value is not ascertainable, it will be 1.125% of what? The customs FOB plus cost of transport. This is the cost of insurance. So this is the most important aspect which we will be discussing now. This is the most important, because you can do the practical question only when you remember these adjustments. This is the most important. So here the value of the imported goods, shall be the value of such goods for the delivery, at the time and place of importation, and shall include what? The cost of transport, loading, unloading and handling charges. That is cost of transport, loading, unloading and handling charges associated with the delivery of the imported goods to the place of importation, and not at the place of importation, Now here, where the cost of transport loading, unloading and handling charges is not ascertainable. Where the cost of transport, loading, unloading and handling charges is not ascertainable, then in that case the imported goods is the same is not ascertainable. Such cost shall be what? 20% of the FOB value of goods. Such cost will be what? 20% of FOB value. If the same is not ascertainable, it will be 20%. And in case if the cost of transport, loading, unloading and handling charges basically is not ascertainable, and FOB value is also not ascertainable, but FOB plus cost of insurance is ascertainable. What is ascertainable is FOB plus cost of insurance. Then in that particular circumstance, this value you know, but you do not individually know the cost of the FOB value individually, then cost of transport, say loading, unloading and handling charges will be 20% of the FOB plus cost of insurance. Then I already told you that air freight cannot exceed what? 20% of the customs FOB value. If actual air freight exceeds what? 20% of the customs FOB value. If actual air freight exceeds what? 20% of the customs FOB value, it will be restricted to what? The 20% of the customs FOB value. Then the cost of, in case say of the goods which are imported by sea or air and they are transshipped to another customs station in India. In case the goods are imported by sea or air and they are transshipped to another customs station in India, the cost of insurance, transport, loading, unloading and handling charges associated with the transshipment, the same is to be excluded. So transshipment costs are to be excluded. Then if any ship demurrage charges on chartered vessels, light rate or barge charges are paid, then the same will be includable. Here the same will be, say, includable in the cost of transport. Same will be includable in the cost of transport. Then insurance charges is to be added. Cost of insurance to the place of importation is to be added. To the place of importation is to be added. If case cost of insurance is not ascertainable, it will be 1.125% of the FOB value. It will be 1.125% of the FOB value. And cost of insurance where FOB value is not ascertainable, then it will be what? 1.125% of the FOB value plus the cost of transport. So fundamentally this is the way you have to do. First of all, you have to determine the free on board value. Then you have to add the costs and charges as referred under rule 10.1. Then here we have to add the actual cost of transport, loading, unloading and handling charges associated with the delivery of imported goods to the place of importation. In case of air, it cannot exceed what? 20% of the customs FOB value. If not ascertainable, it will be 20% of the customs FOB value, and in case FOB value is also not ascertainable, then in case it will be 20% of the customs FOB value plus cost of insurance. Similarly, we have to add what? The cost of insurance, actually that is to be added, and in case the same is not ascertainable, it will be 1.125% of the customs FOB value, and if customs FOB value is also not ascertainable, it will be 1.125% of the customs FOB value plus cost of transport. Now this will give you the CIF value being the assessable value for the purpose of calculating the custom duty. Now if if value cannot be determined as per rule 3, value will be determined as per rule 4. Basically rule 4 is the transaction value of the identical goods. So here we have to see at which price identical goods are imported. That value is to be taken. Identical goods means goods which are same in all respects, having regard to physical characteristics, quality and reputation, as the goods being valued are produced. Imported, say the goods are produced in the same country in which the goods being valued were produced, and produced by the same person who produced such goods. And in case if the goods are not produced by the same person, goods produced by a different person. And here if say more than one value is found of the identical goods, then lowest value is to be taken. Then If you cannot find the identical goods, we find the similar goods. Similar goods are what? Substitutes. They are not same in all respects like identical goods, but they are commercial substitutes. So their value will be taken. If this value is also not ascertainable, then value will be determined as per Rule 7. Rule 7 is deductive value. That is what? The unit price at which the imported goods or identical goods or similar imported goods. Unit price at which the imported goods, identical goods or similar imported goods are sold in India in greatest aggregate quantity. In greatest aggregate quantity, this is price at which the greatest aggregate number of units are sold to unrelated buyers at the first commercial level after importation. To unrelated buyer at the first commercial level after importation. From that, you have to reduce what? Whatever expenses are incurred post importation. That is what? Commissions and selling expenses, transport, insurance, and other associated costs, because this unit price includes everything. When they are sold in India after importation to independent buyer. So commissions and selling expenses and the profits which they are making, that is what deducted. Transport and insurance cost is deducted. Custom duty, taxes, etc., which are levied in India after importation, that are deducted to find out what? The assessable value. Deductive value being the assessable value. And in case if the goods are sold after value addition, due allowance will be given to the value addition. We will be reducing the value addition also. And if they are not sold at the time of importation, then whenever they are sold earliest within 90 days of the date of importation, that will be taken. Then Rule 8, as you are aware, is the computed value. You have to take the costing aspects, that is cost or value of the materials and fabrication and other processing. Then whatever is the amount of profits that are earned by the exporter there, that will be added, and 10 to adjustment, cost of transport plus insurance adjustment will be done. So this way you get what? The valuation. This way you get the value of the imported goods. Okay. So this was the valuation aspect which we have discussed here. Let us see some practical questions relating to the valuation. Then we will be discussing these various other remaining procedures. Say one question is there relating to computation of the anti-dumping duty. Say here, PCB Limited has imported printed circuit boards for sale in India from country X. So they have imported PCBs which are liable to anti-dumping duty. Now here country X does not sell the goods in the domestic market. However, it exports a same printed circuit board is $200 per piece to another third country. So export, this is the normal value, basically the normal value at which the goods are sold to appropriate third country is $200. This is a normal value. Now anti-dumping duty, we levy anti-dumping duty, and as I already told you, the anti-dumping duty is levied which should be here lower of margin of dumping. What is basically margin of dumping? The normal value minus the export price. Normal value is the price at which the goods are sold in the exporting country. If they are not sold in the exporting country, then to the appropriate third country. So normal value is here $200. Export price is the price at which the goods are sold in India. Lower of this, now number 2 is what? Injury margin. Injury margin. Now what is injury margin? That is a non-injurious selling price minus the landed value. Landed value. Now they say that here the printed circuit boards sold in domestic industry is $175. Non-injurious price is $150. 175. And the export price is US dollar 100. PCB has imported the same for US dollar 100. This is US dollar 100 is the export price. That means what? The price at which the goods are sold to the importer in India. So margin of dumping here is US dollar 100. Margin of dumping is US dollar 100, and landed value of the printed circuit board is 125. Landed value is US dollar 125. So the injury margin is how much? US dollar 50. So we can levy anti-dumping duty. Anti-dumping duty will be levied not exceeding US dollar 50. US dollar 50. Okay. So compute the anti-dumping duty for 1000 pieces. 1000 pieces have been imported, and anti-dumping duty will be US dollar 50 per piece, and conversion rate is 75. So this will give you the amount of ADD to be levied. Remember, this is the amount of the anti-dumping duty, lower of the margin of dumping. What is basically the margin of dumping? The difference between the export price and the normal value. Injury margin is a non-injurious selling price minus the landed value. So basically, lower of the two, anti-dumping duty will be levied here. The amount of anti-dumping duty will be 1000 units have been imported. Exchange rate is 75 into 50. That is what? 37 lakh 50,000 rupees will be the anti-dumping duty that is to be levied here. This is the, this type of questions can be asked in your examination. Now, one more question. Say, F Limited imported a machine, and the FOB value of the machine is UK pound 10,000. Now, they have given the FOB value. That is 10,000 pounds. Now here, air freight has been provided 3,000. Air freight cannot exceed 20% of what? Customs FOB value. It cannot exceed 20% of what? The customs FOB value. License fees, buyer was required to pay as per 10(1)(c). License fees will be included. Buying commission won't be included. They have given you the date of presentation of bill of entry is there, and date of arrival of the aircraft has been provided. So exchange rate notified by the CBIC on the date of presentation of bill of entry will be taken. Relating to custom duty rate, it is bill of entry or arrival of the aircraft whichever later. So custom duty rate will be what? Say bill of entry or arrival of the aircraft whichever later. Integrated tax rate has been provided. Insurance premium is not available. It will be 1.125% of the customs FOB value. So you are required to determine the assessable value for and calculate the custom duty. So this is this type of questions they are normally asked. So here we will be add license fees. How much license fees was there? US dollar 400. Then buying commission. Buying commission won't be added. Dollar 10,400 is the customs FOB value. Okay, add cost of transport. Actual air freight is US dollar 3,000. Actual air freight is US dollar 3,000. 20% of customs FOB value will be how much? 20% of 10,400. 10,400. 3,000 into 20%. No, sorry, to 10,400 into 20%. That is 2080. Lower of the two. It is 2080. And add insurance charges. Insurance charges is 1.125% of the customs FOB value, 10,400. Okay. So 10,400 into 1.125%, that is 117. So it is, 10,400 plus 2080 plus 117. 12597. Now exchange rate, you have to apply exchange rate as notified by CBIC on date of, always on date of presentation of bill of entry. Always the date of presentation of bill of entry. Here exchange rate will be 99. When we convert it, it gives you 12,47,103. 12,47,103. Verify it. This is 12,47,103. Then add basic custom duty. Basic custom duty is duty prevalent on date of bill of entry or arrival of aircraft, whichever is later. So here date of presentation of the bill of entry is 25, arrival of aircraft is on 25/5, and rate prevalent on that date is 10%. So the basic custom duty will be added at rate of 10%. $124,710.30. Add social welfare surcharge at rate of 10% of the basic custom duty, that is 12471.03. This will be value for levy of integrated tax. This we have done in the classification chapter. This is value for levy of integrated tax. That is 13,84,284.33. And integrated tax rate they are providing 12%. So add IGST under section 37. You have to add IDST under section 37 at rate of 12%. At rate of 12% of this value of 13,84,284.33, that gives you 166,114.1196. So basically when you add it, it gives you 15,50,398.44. This is the total cost of imported goods, and total duty and integrated tax payable will be 124,710, 1,247, and this is the integrated tax. Okay, this way you have to work out. This is the way you have to find out. Now here we have to write that license fees will be added in the assessable value. Exchange rate as notified by CBIC on the date of presentation of bill of entry is to be taken. Air freight cannot exceed 20% of the customs FOB value. Buying commission will not be included. Insurance charges, if not ascertainable, are 1.125%. Rate of duty on the date of presentation of bill of entry or arrival of the aircraft, which is later, the same will be taken. Okay. So this was a question. These types of questions can be asked in an examination for 5 marks. Basically, this was a question relating to valuation. So one question of computation of the anti-dumping duty and one relating to valuation has been done by. These are practical questions. Now we will be next, in our next topic we will be discussing the import procedure and export procedure, duty, drawback, baggage, etc., and completing the entire aspects which are important from the examination point of view.